Good morning and welcome to our live webinar on how to invest wisely and create wealth with Dr. VK Vijayakumar, Chief Investment Strategist, Geojit, and Mr. Gaurang Shah, Head Investment Strategist, Geojit. Well, the year 2020 saw the best of times and the worst of times for the Indian stock market. The benchmark indices plunged to multi-year lows in March, only to swing back and touch record highs. The first half of 2021 saw the bull run continue and has been churning out good returns for all our investors. Geojit recently conducted a survey for its clients to find out how they are doing with their investments. Well, we noted that many of them stopped their investments during the year 2020, mainly because of what happened in March 2020, and many of them because of financial crunches and problems. We also noted that many of them started new investments, but there were a large number who wanted to invest but had no idea where to invest, when to invest, or how to invest. And that's exactly the reason why we are conducting this webinar for all of you. The first speaker for the day is Dr. VK Vijayakumar, Chief Investment Strategist, Geojit. He's a keen observer of the economy and the financial markets, and he comes with valuable a lot of experience of the economy and the markets. He has been the professor of economics at Sri Krishna College, Guruvayur in Kerala, and he has been with Geojit since 2010. Many of you will know him since he contributes articles regularly to leading financial newspapers like Business Standard, Economic Times, Money Control, etc., to name a few. As clients, you will also know him because he's been a part of innumerable investment awareness programs, seminars, and webinars like these. He always takes time to update our clients on what is happening in the economy and markets through his regular letters to the clients, articles that he writes for our blog, and also for the Geojit Insight magazine. So let's listen in to what Dr. Vijay Kumar has to tell us today. Sir.
Okay. Thank you, Jyoti. Good morning to you. Good morning, Gaurang. And good morning and hearty welcome to all the participants. It's nice to be with all of you this morning, even though we are meeting virtually. Talking to clients is always an interesting experience. Friends, as Jyoti said at the beginning, we are in a ferocious bull market. In 2020, we had the best of times and the worst of times. And starting April 2020, we are having a ferocious bull run. And this bull run is a global bull run, not something confined to India. Actually, most of the markets are doing exceedingly well. Some are doing better than India. The mother market, US, whether it is Dow Jones or NASDAQ or S&P 500 or Russell 2000, records are being broken. Europe is doing very well. With the exception of a few countries like, let us say, Iran and Egypt, which are mired in economic problems, all other markets are doing exceedingly well. And the valuations also are very high. I would even say valuations are excessive. So investors are a little bit confused. I'm getting a lot of calls and mails and queries almost every day, including yesterday, as to what should we do in this current context? Should we sell and get out of the market? Or should we continue to invest in the market? Or should we just hold on to our investments? A lot of questions are being asked. Well, nobody has a very clear answer for all the questions because stock market is almost unpredictable. The future, the short term is very much unpredictable. Therefore, let us try to get the issue in perspective. Let us analyze the situation and try to draw our own conclusions. Well, as I said just now, we are in a ferocious bull market. And this bull market is a global bull market. And there are a few factors driving this bull market. It is important to understand the factors driving this bull market. First factor is the huge liquidity, the unprecedented, the humongous liquidity that has been injected into the global financial system. After April, after March, I would say, after the pandemic broke out and we had a record crash in the market in March 2020, central banks have been printing currency and unleashing currency on an unprecedented scale. And the leading central banks of the world, under the leadership of Fed, then the European Central Bank, Bank of Japan, Bank of England, all these leading central banks have been injecting huge liquidity, and that liquidity comes to more than $10 trillion. $10 trillion, which is 3 times the size of India's GDP, has been injected into the global financial system. And money is like water, it finds its own level. So when you have too much liquidity floating around in the system, well, this liquidity will start chasing asset classes which can give good returns. And the returns from fixed income, the returns from debt instruments is at a record low. It is close to zero. Therefore, more money is chasing risky asset classes like equity. That is one factor, a very important factor. Secondly, a very important factor, this also is a little bit unprecedented, is the presence and the influence of retail investors. Retail investors have become a force to reckon with all over the world. We are aware of the Robin Hood phenomenon. In the US, retail investors have brought even the very powerful hedge funds to their knees. I'm referring to the GameStop episode. In India, during the financial year 21, 1.47 crore new investors have come to this market. And these new investors, and let me tell you, I would say these new investors, their awareness about the market is very, very doubtful. They don't have much of an experience. They have never witnessed a major correction in the market. Many of them are under the impression that Wall Street and Dalal Street are one-way streets, and they have been successful. Therefore, they have been investing merrily, and every dip is being bought, and the retail investors are playing a very important role in this. That is the second point. Thirdly, the global economy is turning around after the recession of financial year 20. There is a strong rebound in growth in the US, in Europe, in China, in India. This year, the growth rate is likely to be 9.5% real GDP growth. So when the economy is doing that well, the corporate earnings also will improve. Fourthly, it is to be understood that even though there has been a big hit to the economy, particularly the MSME segment, the medium, small, and marginal enterprises have been hit. There is huge unemployment. The unorganized sector has been bleeding, but the organized sector has been doing exceedingly well. And it is important to understand that the stock market represents the organized sector. The organized sector has been even growing at the expense of the unorganized sector, with increasing market share. They're grabbing market share at the expense of the unorganized sector. So that is one of the reasons why, paradoxically, the stock markets are doing exceedingly well when the rest of the economy is faring poorly. So this is the context in which the market is scaling record highs. Now, something which is very important for all investors to understand is the market valuations. It is important, as Benjamin Graham famously said, intelligent investment is all about buying right securities at right valuations. So valuations are important. So where do valuations stand now? Let us look at the mother market. In the US, if you take the important indicators, first let us take the Buffett indicator, popularized by Warren Buffett, the market cap to GDP ratio. The market cap to GDP ratio is now at 205, very high. Even during the dot-com bubble of 2000, not dot-com bubble, global financial housing market bubble of 2007 end, 2008 beginning, it was around 155, 160. Now it is 205. And that's why many economists many market experts are talking about a bubble building up in the market. Then if you take the price earning ratio, you take Standard & Poor, for instance, S&P 500, which represents the market correctly rather than Dow Jones or NASDAQ, which represents only one segment of the market. The PE ratio for S&P 500 is now 46. Is now 46. Historic average is between 16, 17, 18, that range. So that way also markets are overvalued. If you take India, well, our average historical average market cap to GDP is 77. Now it is 115. The historical PE ratio is around 16. Now presently the market is trading at a PE of 21, 22. I'm talking about the forward earnings. Financial year 22, forward PE is around 22. The mean price to book in India has been 3.3. Now the price to book is 4.4. So if you go by the traditional, the accepted parameters of valuations, there is no doubt the market is overvalued. So if the market is overvalued, the next logical question is it ripe for a correction? Is a correction imminent? That's what makes this market interesting. Even though the market is highly overvalued, there are no signals of a sharp correction in the horizon. Normally, the signals for a correction will emerge from, let us say, persistent inflation. Now, inflation has gone up even in the US, but economists believe, most of them believe that inflation is a transient phenomenon, not persistent. It will go up, and it is going up now, but it will start coming down in a few months. And the Fed is prepared to tolerate a higher level of inflation. Another major signal for a market correction, I'm talking about global correction, because this is a global rally, therefore a correction also will be global. And the correlation between markets globally is very high. So a correction will not be a correction confined to a particular a market for a particular economy. Of course, it can be caused by domestic factors, but if a correction is to happen, that is likely to be a global correction. And global corrections have happened in the past when the Fed turns hawkish, when the leading central bank, the Fed, turns hawkish and starts talking about raising interest rates. It does not happen all the time. We had bull markets along with rising interest rates, but then the Fed turning hawkish and indicating increase in interest rate, which means the bond yields are likely to go up. And when bond yields go up, well, there will be more money flowing into fixed income rather than equity. Particularly overvalued equities will be sold and fixed income will be bought. These are the important indicators normally of a correction, and these indicators are conspicuous by their absence. That is why it is quite possible that even though the markets are overvalued, this overvaluation may persist for some time. The market can even go up in the coming weeks or months. We are not sure about the trajectory, but it is quite possible. So you have to keep in mind these two important factors. Markets are overvalued, no doubt about that, but then the indicators for a correction are not present right now. Now, in our letters to clients, starting from the March crash of 2020, starting from April, we have been communicating to our clients to remain invested, to buy systematically and to remain invested, not to sell and get out. Even when valuations are very high, our investment strategy has been to hold on to your investment, systematically invest in high quality stocks. If possible, invest periodically in the market leaders, particularly in sectors where there is earnings visibility, like in IT, for instance, or pharma or metals, where there is earnings visibility. Buy into the large caps, the market leaders, because your investment will be safe with market leaders. Even if we have a crash, these blue chips will come back, they will bounce back like a rubber ball. So at this context, I would slightly change a slight tweaking of the investment strategy that we have been advocating all this month, starting from April. Now we would slightly tweak the strategy like this. Remain invested, particularly remain invested in performing sectors, which I have mentioned just now. Remain invested in quality names, the blue chips, the market leaders in these segments. But since most investors, assuming that most investors are sitting on profits, because if you have been a very systematic investor, you must be sitting on a lot of cash, book some profits, particularly from stocks which have run up too fast, particularly in small caps and mid caps, where the sharp rise has not been backed by fundamentals. If there are cases like that, book profits and increase the cash component in your portfolio. Also move some money to fixed income, even though the fixed income returns are not very, very attractive. That would be a safe investment strategy at this point of time. But this is only one part. The other part, the main plank of the strategy is to remain invested in the performing sectors like IT, pharma, metals, cement, and my friend Gaurang will give you more information about the sectors and particularly about the stocks. So partly book profits, increase the cash component in the portfolio. There can be a correction. We don't know when the correction will happen, but remain invested in the blue chips in performing sectors. I saw some of the questions being asked for this webinar, and also the questions that I've been getting in recent weeks and recent months. How to benefit from investment, what is the ideal long-term investment strategy, etc. Now, it is important for you to understand that you will gain from the power of compounding, you will gain from the India growth story, you will gain from the inevitable wealth creation that happens in the market only if you remain invested for long. You must be knowing that in 1979, Sensex was 100. Now Sensex is above 52,000. That means the market has multiplied 520 times. 520 times, yielding SEAGR, compound annual growth rate of 16%. And if you have been very intelligent and smart to invest in wealth creators like Infosys or a Reliance Industries or an Asian Paints or a Wipro or an HDFC Bank or an HDFC or HUL, well, you must be sitting on crores of rupees worth of profits. Therefore, it is important to remain invested. Even if the market is overvalued, it doesn't mean that you should exit from the market, sell and exit from the market. Never do that, because wealth creation happens only when you remain invested. And also, it is important for you to remember one very important fact. More than 80% of corporate India's net profit comes from 20 companies, around 20 companies. Companies like Reliance Industries, HDFC Bank, HDFC, ICICI Bank, Axis Bank, Infosys, TCS, Wipro, HCL Tech, HUL, Bajaj Finance, Asian Paints, you name it. There are some, there's a big pool of profits available, and going forward also, these very same companies will be generating profits for India Inc. Therefore, it makes sense to remain invested in these stocks, and investing in small caps and mid caps should be ideally done through the mutual fund route. Ideally, you can invest through the SIPs in small caps and mid caps and flexi cap, because the small cap index is a small cap space is a minefield. Therefore, there is a possibility that you might lose money, whereas if you invest in good mutual funds, so the SIP route, you will be laughing all the way to the bank in the long run. Now over to Gaurang, and we will come back to the question and answer session later.
Thank you, Dr. Vijayakumar. Well, the next speaker for today is Mr. Gaurang Shah, the head investment strategist at Geojit. Mr. Shah is also known as the face of Geojit, and is always, you can always see him on leading news channels like ET Now, CNBC TV 18, CNBC Awaz, CNBC Bazaar, and Radio Dubai, to name a few. He regularly offers advice on investment opportunities across various sectors. A graduate from in commerce and economics from Mitibai College in Mumbai. He has over 20 years experience in the capital markets, and he's an expert on global markets, namely the US, Europe, Asian and emerging markets and the impact that it has on the Indian equities. He regularly interacts with all our clients, just like Dr. VK, through numerous investor awareness programs and seminars and webinars. So over to Mr. Gaurang Shah.
Thank you, Jyoti, for those kind words, and thank you everyone for joining this webinar on Sunday morning. Uh, Along with all of you, I would also like to thank the entire corporate communication team at our head office in Geojit for getting together this webinar and making this event a successful as we approach the end of this event. Just referring to what my friend Dr. VK mentioned about markets, which hit a low somewhere in March 2020. And for the benefit of all of you all who are not aware in terms of numbers, then the date was 23rd of March 2020. And the low that Sensex touched was somewhere close to about 25,890 odd. And the Nifty low on that particular day, 23rd March 2020, if I'm right and my memory serves me right, the low was somewhere close to about 7,610. From those levels, as of present date, that means in about 14 or 16 months, Sensex is at about 53,300. Again, 52,300, I beg your pardon. And Nifty is somewhere close to about 15,600. I stand to be corrected, plus minus 50, 100 points. So you can just imagine the kind of return. If only you would have invested in index, that is Sensex and Nifty, you can imagine the kind of return it would have generated. Along with that, if you would have invested in certain stock specific ideas, then that return would have been even multi-folds, because some of the stocks have even given much higher return compared to your benchmark Sensex and Nifty. Friends, in effect, what I'm trying to say is that stock market is all about finding opportunities in crisis. And whether that crisis was of that Lehman Brothers crisis, as my friend Dr. VK referred to in 2007-8, or whether it was earlier than that, the scams which hit Indian markets, whether it was Ketan Parekh or whether it was Harshad Mehta, or in between this time, whether it was the crude oil prices, wherein we saw crude oil prices somewhere in 2014-15. Again, if my memory serves me right, Brent and NYMEX hit almost about $125, $130 a barrel. So in all these situations, friends, there were investors, intelligent investors, who identified opportunities in crisis. And stock market, friends, as my experience tells me, is all about finding those opportunities. And as one of the great gurus have also said, that when there is fear in the market, you have to be greedy. And when there is greed in the market, you have to be fearful. So it all sums up to the one thing that I want to get across this Sunday morning to all of you all who've joined this webinar, that do not shy away or fear away from crisis. In fact, the success of investment supports and complements all those investors who find opportunity in crisis. And that's what I personally have experienced in my investments. Of course, I cannot directly invest into equity markets because compliance and other issues, but I'm an active investor into mutual fund via SIP route. And I have been, in fact, to be honest with all of you all, when the markets corrected over the last 1 year, especially in March, April up to December, I had increased my SIP allocation. And I had also started certain new SIPs, and that's how you benefit. So coming to the markets, well, our sense is that this is a small trailer, if you will, of the success story that Indian government, policy decisions, implementation at ground level, and various other policy changes that were undertaken by the government to support the Indian economy in form of stimulus or in form of production link incentive schemes, or whether it is to do with improving healthcare infrastructure. Couple of things that are on the positive side, and then of course I will touch upon some of the things which are a little bit negative for our economy. So positive side is we are possibly heading towards a lower trajectory as far as inflation is concerned, lower interest rates, improving GDP numbers, and if the IMF and the World Bank and of course the most respectable RBI governor emulate to our GDP number, forget about 10, 10.5 or even 12, which was predicted by international agencies. Even if we are growing at 8.5 or 9% plus, I don't think there is any country in the world that can come closer to the number that India will clock in terms of GDP growth rate. And I hope my friend Dr. VK agrees with me over this on this. So if you have an improved GDP number, if you have improved corporate numbers coming through, then definitely you have a re-rating of the markets on the higher side. And let me tell you, friends, market has its own mind. It will display extreme exuberance in good times, and it will shock you when the tides turn and the markets correct. But in all this, we have to find opportunities. And our sense at Geojit is that, along with making investors long-term investors, we also strive to make them educated investors, basically understanding what sectors to look at, what companies to look at, how to invest, why to invest. And most importantly, friend, I refer to greed and fear. In markets, all of us get extremely attracted towards the greed factor. And that greed eventually turns out to be one of the greatest contributor to our underperformance in investment strategy as far as equity market is concerned. So when you say that you're getting 5% or 6% on your bank FD, or maybe a little bit higher on your PPF account or your government bonds, etc., or your investment in land, on a positive side, as far as equity markets are concerned, and this is a data which is proven historical track records, that equity market investment, if it is done with little bit of understanding, little bit of knowledge, and most importantly, discipline and principle manner, then there is no investor which has got disappointed as far as returns from equity market is concerned. It's purely simple logic, and there is no rocket science to that. Our belief at Geojit is that possibly, since we have made a new high very recently, markets would go into a consolidation phase, and that is what exactly has happened over the past many years. Every time the markets hit a new all-time high, there is a tendency for market to consolidate, make a strong base, and on fallback of good government policies, on fallback of lower inflation numbers, improved GDP growth rate, better IIP numbers, and lower than expected interest rates. And most importantly, in all these things that I've mentioned, corporate earnings. Now, since I've mentioned about corporate earnings, friends, we saw a curtain down for the last quarter, last financial year very recently. And this week on 8th, if I'm not mistaken, we had the curtain raiser for the first quarter earning this financial year. TCS came out with its numbers, Avenue Supermart came out with numbers, and starting tomorrow, that is Monday, we will have many companies deliver their first quarter numbers for this financial year. And our sense is that the first quarter earning, keeping in mind that we had a severe lockdown 2.0 in April and May, there could be slight disappointment in some of the sectors. But our understanding is that disappointment is not going to be big enough for markets to go into a reverse mode and correct to a large extent. Of course, at 52,000 plus and at 15,000 plus on Sensex and Nifty, in terms of numbers, the correction might look a little bit larger, but in terms of percentage, since we are at a higher base, the correction will be relatively lower when you see it in terms of percentage and not in terms of numbers. So not ruling out a little bit of consolidation and a little bit of correction, maybe disappointment in certain sectors in first quarter, the likes of FMCG, likes of real estate, banking and finance, NBFCs, autos, since there was complete lockdown, dealers had to shut down their shutters. So your month-on-month numbers were looking not so good, and there were little bit of shortcomings over there. So you might see a little bit of disappointment in these sectors, but barring this first quarter earnings, if there is not severe third wave, and if we as citizens of India behave responsibly and do what we are told to do, then I think we can overcome the third wave sooner rather than later. And that impact of that third wave would be much lesser than what we've seen in the second wave. So second, third, fourth quarter, our sense is that the earnings is likely to improve to a great extent. And there is definitely going to be a re-rating coming through. There are a lot of questions that were asked when our team, our colleagues, Jyoti and all of them shared the Q&A session. And most of the questions were that where do we find investment ideas? So friends, let me tell you this. When you register as a client with Geojit, you have to give your necessary KYC related documents. And along with that, you also have to give your registered email ID. We have a team at Geojit in our head office, research team, which comprises of almost about 8 to 10 plus members who regularly come out with research reports on various companies. And these research reports are by default mailed to all our clients on their respective email ID. So friends, if you have not, I hope you have registered your email ID and you are checking your emails, but just go into that junk mail folder also, because by default, sometimes if you have set certain parameters on your email ID as far as security is concerned, then those mails go into the junk folder. So you need to retrieve them and bring it back into the focus mail. And if you're not receiving it, my humble request is that please get in touch with our team in your respective city. Branches are there. Our team is there. Go and find out as to why you are not getting those research reports. And if you are not getting it, then our team in the respective city and the branch will definitely help you resolve those issues. But we, as a corporate house, as a responsible brokerage house, as a brokerage house which is very focused on to well-being of our clients and improving knowledge of our clients, we regularly send this, and it's a very simple report. There is no high complex language jargon, if you call it. It's not there. It's a very simple 2-page, 3-page report in simple English, which you can understand very well. And if you have any difficulties, our team is there. And if they are not able to solve those queries, then definitely we are here to solve your queries and appropriately answer them. But please refer to those research reports. And what I have done is I have also prepared a small model portfolio, which we'll be flashing it during the question and answer session. What I've done is I've tried to identify 7 sectors. And in those 7 sectors, we have tried to identify at least 15 companies. Of course, the universe is much bigger, but since we have limitation in terms of time, I have tried to shrink it down as much as possible. So 7 sectors, and from all those 7 sectors, we have identified 15 stocks. Not necessary you need to invest in all those 15 stocks. You can shortlist from them. And I think all these stocks that are there in this model portfolio would definitely be a part of any fund manager's large cap or a mid-size cap fund or a balanced fund, because these are the companies which have shown performance year after year, and they have improved the wealth of the long-term investors over a longer period of time. So you will definitely have an opportunity to note all those names down once those recommendations are flashed on the screen during the question and answer session. Like Dr. VK mentioned, extremely positive about IT pharma, extremely positive about certain private sector banks public sector banks and all those names will be coming through in a while. Autos is something that is also exciting. FMCG, that is fast moving consumer goods, and metals and cement. So that's the broad universe that I have listed down in terms of sectorial picks. And forget about foreign institutional investors, because a lot of people ask me, Gaurang, what are FIs doing? Now, if I knew what they are doing, honestly speaking, I wouldn't be sitting here, to be very honest. And we only come to know what FIs are done after they have done. We don't come to know prior to that. So don't try to follow what big investors are doing. You need to understand your capability, your capacity, your risk taking appetite, and accordingly on those calculated steps should be taken, and appropriately investment should be done. I'm quite sure earnings are going to improve, and for the change, we have a new cabinet in place by Honorable Prime Minister, announced a couple of days back. He's brought in young blood, young experienced minds. Certain crucial portfolios have been shuffled, and I'm sure that all those portfolios which are allocated to the young mind with sizable amount of experience will definitely do a great job going forward from here on. So notwithstanding, and more importantly, friends, we are at the beginning of the monsoon season. And according to the, and monsoon is also an integral part to our economy, because large part of our population depends upon agri activity. And along with that, friends, we have 140 crore uh, population to feed to. So luckily for the third or the fourth consecutive year, rain gods have been kind enough. At least the beginning has been quite positive, and I hope as we progress further, the equal distribution of rain should help agri production, and along with that, it will also help self-reliance as far as certain crucial important agri commodities are concerned, which we need to import because of lack of production, because of lack of experience, because of lack of availability, etc., and wastage. So monsoon, good enough. First quarter number, not all that bad. And along with that, uh, better domestic data points. We should be heading towards, I hope I'm not wrong, but by December 2021, if our calculation goes right, and if the pandemic doesn't have to play a spoil sport, then we should be heading towards 16,500 on Nifty spot, and so forth for the Sensex. There will be intermediate bouts of correction, which, like I mentioned, all negativities should be looked at, all crises should be looked at investor opportunity, and your focus, energy, channelization of your capital should be made towards investing in strong fundamental sound companies. One more advice I would want to give, or one more word of cautious, is that don't get attracted to unknown names. Don't get attracted to certain corporate houses which have been wealth destroyer rather than being wealth creator, just because they have rallied 50, 60, 70%. My humble request is that you should buy quality, don't buy quantity. What I'm trying to say is, don't buy large number of stocks of lesser known companies, but buy quality stocks, few shares of quality companies which have got proven track record and great corporate governance and great capability and management in place. I am quite sure that this interaction will have a positive impact over a period of time. And if everything goes well, then I'm sure we will try and strive to have more interactions like this. We would want to reach out to all of you all. Unfortunately, because of the pandemic, my friend Dr. VK and myself cannot travel, and there are restrictions in terms of having investor awareness program meet. There is restrictions in terms of how many people can come. But what we have done is we have tried to reach out to our clients, our guests through this webinar. And I'm sure in future we'll have many more opportunities and interaction. Uh, I'm always been an optimistic guy, and I will be optimistic as far as India growth story is concerned. I'll be optimistic as far as Indian growth rate in terms of equity market is concerned. And let me tell you, there is a good old saying, you can hate India, but you cannot ignore India. I'm talking in terms of the progress. The most unfortunate part is that we have two neighbors on our shoulders who are playing spoil sport. Now, this is a geopolitical angle that I'm talking about. That could create a little bit of disturbances on and off because of border tension. The other factor that I wanted to refer to was the crude oil. We are virtually at a 3-year high on Brent and NYMEX, dollar per barrel. And we also know the price that we pay for a liter of petrol and diesel. If crude oil prices have to go higher, then this may create a little bit of unwarranted, unpleasant situation for our economy, because India at present imports almost about 70% plus of our energy requirement. And on the flip side, with rising crude oil prices, if you have a rupee which is weakening against the dollar, then it's a double-edged sword that may play a little bit of spoil sport for the numbers to achieve in terms of GDP growth rate and in terms of performance for the Indian equity market and corporate numbers. If the production has to go up by OPEC plus, the meeting was there, but unfortunately they could not decide, and that has been postponed. And if we have to have inflation numbers down thanks to great monsoon and good agri production, then I think we are possibly positioning ourselves to a much higher level going forward from here on. And one more thing, last year when I was referring to 23rd of March, Sensex at 25,800 and Nifty at 7,610, that time we did not have any vaccine. And this COVID-19 was an alien in the most darkest form. Starting this year, thankfully, we started off with 2 vaccines, and now we have more vaccines coming through in terms of priority approvals, etc., emergency use, etc. And as we go forward, and as the government has been telling us that more and more research related investments are done and more vaccines are getting approval, possibly the situation could improve sooner rather than later. So friends, use all crises as opportunity and try to identify investment ideas. We are here to help you, and a model portfolio list will definitely help you in filtering it down to select number of sectors and stocks. With this, I will conclude my verbatim, and I would request Jyoti to take up Q&A session, and we'll try to take up as many questions as possible, but due to time factor, in case if we are unable to take some of the questions, then I'm sure our team will be able to take care of that. Over to you, Jyoti. Thank you all very much for being so patient and listening to me so patiently.
Thank you, Mr. Shah. As always, we've got a lot of questions, and it's impossible to answer all these questions. But we did share these questions with Dr. Vijayakumar and Mr. Shah, and I think they have tried to include and answer most of the questions in their presentation. But we have a few questions that they will answer now. So first we'll go on to Dr. Vijayakumar, and then we'll ask Mr. Gaurang Shah the questions. The first set of questions are for Dr. Vijayakumar. So the first question is the age of the individual an important factor in deciding the type of investment?
The age of the investor is one factor, but not the only factor. Normally, we say that the proportion of investment in equity should be 100 minus your age, right? So if you are 30, 100 minus 30 equals 70, you can invest 70% of your investable funds in equity. Whereas if you are 65, a retired person, 100 minus 65 is 35, park or invest only 35% of your investable funds in equity. But this is not a rigid rule. This is not a hard and fast rule. Recently, I came across, I had written about it. Recently, I came across a gentleman who is 75, and his son was saying that he is over invested in equity because 80% of his investable funds were in equity. But when I look at the portfolio, I said, even at 75, he should retain his equity component at 80% because he had built up a great portfolio consisting of stocks like HDFC Bank, HDFC, ICICI Bank, TCS, Infosys, Hindustan Unilever, Asian Paints. It was an enviable portfolio. He has built up an excellent portfolio. So just because he is 75, that doesn't mean that he should reduce his equity component. And also he and his wife had a monthly pension of around more than 1 lakh. And for his kind of lifestyle, he needs only 25,000 rupees a month. So in spite of the fact that he is an old person, an elderly person, his risk profile is very high. His risk profile is very high, right? Therefore, the amount of money that you should invest in equity, the amount of money that you should invest in equity should depend upon your partly on your age, partly on your risk profile, and also partly on the financial goals, right? Mostly it should depend on your financial. What are your financial goals? If you are in your early 30s and your financial goals are giving good education to your children who are now in kindergarten, constructing a house, buying a car, etc., you can invest for the long term in equity. Whereas if you are about to retire and if you have to live your post-retirement life with the returns that you get from your provident fund, gratuity, etc., your risk profile goes down. So there is no hard and fast rules, but as a thumb rule, as you grow up, as you advance in age, the equity component should come down. So I repeat this point, age is one factor, but not the only factor.
Dr. Vijayakumar, when you were making your presentation, you said a lot of new people have entered the market. So I think this question is from one such person. They want to know whether you can make fresh entry at record high market levels.
Well, you can make entry, depends on what kind of entry you make, right? Systematic investment plans, SIPs, in equity funds, hybrid funds, can be done at any point of time. If you are entering the market at record levels and if the market is going down, then your SIP will enable you to buy more units at lower prices. So any time is good time for systematic investment plans through mutual funds. But if you are, very eager to make a bulk investment of, let us say, 5 lakhs in the market now, I would suggest that you should be very, very cautious because the market valuations are high. And if you have some 5 lakhs to invest, I would suggest you go for a systematic transfer plan where you put this 5 lakhs in a liquid fund and make arrangements for 20 systematic investments in equity over 20 months so that the volatility of the market can be exploited. So this is not the time, in my assessment, for a bulk investment, but this is the time for systematic investment. Always SIP, anytime, whether the market is going to go up or whether it is going to go down, SIPs will benefit you.
The next question is, if I only have a small amount of money to invest, is it even worth it?
Oh, yes, certainly. It doesn't matter whether you have 500 rupees or 5 lakhs or 50 lakhs. No, everyone starts with a small amount of money. Rakesh Junjunwala started with 5,000 rupees, right? So even if you have 500 rupees a month, start a systematic investment with 5,000 rupees, 500 rupees. No problem at all. The amount of money is not very relevant.
Yeah, so it's not the amount of money, but investing it in the right place, I guess.
Exactly.
The next question is, how safe and consistent will the Indian equity market be going further?
Well, Indian equity markets will be safe, but consistency is not the quality of the stock market. Stock market will be always volatile. It has been volatile. It will be volatile. It will be more volatile going forward. because of many factors that I indicated earlier. So don't expect consistency from the market. Of course, there will be consistency in returns. In the long run, you can certainly expect some 12% plus returns from the market going forward. It has delivered 16%, as I've already explained, CAGR, if you take 1979 and 2021. But don't expect consistency in market movements. Don't expect, let us say, very safe, steady movement of the indices. That is not the nature of the beast. It will be always volatile. But if you're a long-term investor, you can expect consistently good returns.
Since you mentioned long-term investors, they want to know what are the things that you should focus on as a long-term investor?
Well, normally we say that your investment horizon should be at least 3 years. But the youngsters are very impatient. I told you about the Robin Hood generation, the Robin Hood phenomenon. Modern day youngsters are very impatient. They want the returns very quickly. Well, you will not get quick returns in the stock market. Sometimes it is possible, like during the last 1 year, some stocks have given 2 times. My friend Gaurang told you about the journey of the Nifty from 7,610 on 23rd of March 2020 to, let us say, 15,600, 700, 800 now. So the Nifty has more than doubled. But there are many stocks which have risen 200%, 300%, 400%, right? Even more than that. I'm not talking about the very small caps, even medium cap, mid cap stocks have appreciated like that. So if you're, so since the markets are highly valued now, excessive, I will not call it a bubble, even though many people like even legendary voices like Ray Dalio are talking about bubbles. We should be concerned because if for instance, the US Central Bank Fed starts talking about tapering and raising interest rates much earlier than the market expects, there can be a correction in the market. So since the market valuations are high in the current context, you should have a longer time horizon of 4 years, 5 years and beyond. So if you have a time horizon of 4 years, 5 years, continue to invest systematically, continue to invest in good quality stocks, which Gaurang will, he has already referred to that, and the slide which will be shown will give you an idea of which are these great companies in performing sectors. Invest in them and wait with patience. You should have a time horizon of more than 4 or 5 years in the current context.
So the next question is how to achieve compounding effect of investing.
And that has already been explained, Jyoti. I told you that from 1979, 100, Sensex is now more than 52,000, 16% CAGR. Only a person who remained invested during this period got the 16%. If you had exited from the market, you would not got that. In March last year, last week of March, when this big market crash in a very short period happened, one of our managers in Kerala rang me up and said, one of our clients wants to talk to me. He had a mutual fund investment of 70 lakhs, not a small amount, 70 mutual funds. And he was concerned about this pandemic, and there were no vaccines at that point of time. Many horror stories were being painted. So he wanted to sell. So the manager said, you speak to him and then you can take a decision. So he was very pessimistic. I told him, if you need money and if you are very negative about the market, you can sell a small part. I will not suggest that you sell at this point when the markets are down and valuations are very attractive and the markets can go up. You can sell a small part, because he told me it is my hard-earned money and bulk of my investment is in this. But I told him, don't exit from the market. But he exited from the market because he got some wrong kind of advices. So had he continued with that investment, it would be worth 1.6 crores now. So think about the loss that he incurred, right? So it is important that you stay invested. Then only you can enjoy the power of compounding. Stocks like Infosys, HDFC Bank, Asian Paints have given returns, CAGR of 25%, 30%, you will be surprised 35%. And to get that kind of compounded returns, you should remain invested for the long term.
So as Dr. Vijayakumar has always said, time and again, invest in quality stocks be disciplined with your investments, and do stay invested for the long term. And don't let the markets sway you. Otherwise, I'm sure most of you will end up with good returns and create wealth in the process. The next set of questions are for Mr. Gaurang Shah. The first question, sir, is long-term investment strategy for retail investors. That's at least 5 years, and how to avoid erosion of wealth.
Thank you, Jyoti. So, long-term strategy, as my friend Dr. VK just referred to, discipline and systematic investment. And like I mentioned, that identify crisis as opportunity. And not only now, markets have a history to tell you that whenever there has been extreme fear, uh, there has been opportunity for smart and intelligent investors to create wealth by investing at that particular point of time. So don't go after names which are lesser known. Don't go and buy stocks just because from 100 rupees it has corrected to 20 rupees, because there is not one but one too many reasons why the stock was at 100 and now it is at 20. Don't buy because the stock is cheap, not necessarily that cheap stock will give you multiple returns. So don't make that mistake. Buy quality, don't buy quantity. Stay invested for a longer period of time and regularly invest. Don't try to be in a hurry to invest in the stock market. This is what I tell everybody, that there will be tomorrow for you to invest in the stock market and better levels in opportunity. But when it comes to booking profits, I think you have to and booking profits with a view that your estimated return is in place. Then if not all your investment, but at least part of your investment, you should book profits and bring home that capital and profits that you earned. And one simple thumb rule that you have to follow is follow the recommendations that are given by Geojit's fundamental team. And I don't think you will go wrong over there. Or simply you can note down the stock recommendations that we will be sharing in a few minutes in terms of a model portfolio. Uh, See, stock market has got is a wide universe. It's every day there is a new story. Uh, you don't have to follow each and every story, because by doing that you are not only destroying your objective and goals, but along with that you are also you know unnecessary wasting your hard-earned money, capital, and investments. And you have very limited resources when it comes to that. So you need to be extremely careful, cautious, along with that, a little bit of elevated risk appetite, because stock markets are subject to all sorts of risk. So you need to be a little bit careful when it comes to getting misguided by certain rumors or false propaganda which are plentifully available on various social media platforms. One simple thing you can do is follow the recommendations that are given by Geojit fundamentally.
The next question is, please help me with mid-cap stocks for 15 years where we can invest one time and SIP.
So one-time investment, well, if you have a very high risk of appetite, because as Dr. VK and I also mentioned that, we are at a level where we have not been before. We are very close to the all-time highs that we very recently made. And wherever markets make an all-time high, markets have a nature and tendency to consolidate, correct a little bit, see some bit of profit booking. Mid-cap, no, see, that's a wide universe. So instead of selecting and, your main objective is to create wealth. Now, whether you get it from a large cap, mid cap, or a small cap, or a no cap, that's a different story altogether. But this list that is in front of you of 7 sectors and 15 stocks, I think instead of being uh, very focused about mid cap or small caps, you need to focus upon creating wealth. And if you're talking about 10 years, 15 years, then my friend, use this 15 stocks as your first step on the ladder towards investing in equity market. Don't rush into investing in all 15 stocks. You can shortlist as per your convenience, risk appetite, and make a beginning. And since you're talking about 10-15 years, I think you can do an SIP in all of these stocks or any of these few stocks that you feel are most appropriate in terms of themes of growth story going forward from here on.
The next question is, what is your valuable opinion about private insurance companies, small and mid cap, IT scripts, and FMCGs?
So FMCG, there are two names in front of you. IT, I have identified two large cap, TCS and Tech Mahindra. But mid cap IT, there are, for the benefit of this guest or this client, Mindtree, L&T Technologies, L&T Infotech, Persistent System, Science Limited. These are some of the mid cap IT companies that will definitely create wealth. One more thing I would, for the benefit of all our clients, we as a brokerage house, we try to limit our recommendations in the small cap universe because of the nature of the small cap index. It's very volatile. It has got its own, revenge uptrend and revenge downtrend. That is, it will go up like 5-6%, and it can come down also equally at that level or maybe more with that speed. So small cap, there is a very limited universe, which I would personally not like to talk about on this platform. But IT have mentioned FMCG. Other than HUL and Tata Consumer Products, we are positive on Dabur, Marico, Godrej Consumer, Imami Limited, Britannia, Nestle, just to name a few in terms of our sectorial picks.
The next person wants to know that in which shares of the Tata Group should he invest for the next 5 to 10 years? And the next question is, in which sectors should he take long-term position? He also goes to mention that the Geojit recommendations have been doing well in the past 1 year, giving over 100% returns to our clients. And unfortunately, he's just been a spectator watching, but he wants to invest now and hopes to build a good portfolio with advice from Geojit.
Well, first of all, thank you for that compliment, because in our kind of job, we don't get many compliments, right, VK? We are more
exactly
sitting down with a rod rather than get complimented. So thank you for the compliment. And in terms of rather being a spectator waiting on the sideline, I think it is high time you jump into the arena. Like my friend VK and I have mentioned, follow the principles of investment. Don't have a herd mentality. Step out from the crowd and wear your own thinking cap. Take appropriate decisions with a calculated risk, and then invest. So the question first was, which of the Tata Group companies? Well, if I'm not mistaken, as a corporate house, we are positive on almost all the Tata Group companies. But if I have to name a few, the first name in the IT is TCS. That is also a Tata Group company. We are positive on Tata Motors. Tata Global Beverages is the next one in the list amongst the FMCG plays that I've mentioned. In the metals, another Tata Group company you will see, that is Tata Steel. And Tata Motors. These are the few. And of course, not to forget Tata Power amongst the power generation, because their venture into solar energy is going to have a huge positive impact as far as their financial performance is concerned. So these are some of the Tata Group names that we are extremely positive on. Jyoti, you will have to help me with the second question because I lost track of that.
He wants to know the sectors in which he can take long positions.
So sectors are there in front of you. There are 7 sectors, starting with IT, pharma, healthcare, private banks, one public sector bank, FMCG, autos, metals and cement. I think if you follow these 7 sectors, I'm quite sure in the next 3, 5, 10 years, you will be laughing your way to the bank.
Okay, the next question is the last question. What is your view on the markets for the next 6 to 12 months?
I give up on this one because this is very difficult. Uh, like I mentioned, next 6 months, I spoke about December 2021, and I have put all my guts together, and I have spoken a level of 16,500 on the Nifty spot. But I'm quite sure that in all my last 3 to 5 year projections in terms of Nifty and Sensex, uh, by the grace of Lord Almighty and better understanding, those levels have been, overshot. So I'm quite sure that by December 2021, we either will be at 16,500 or beyond that. And possibly, if we are able to, if not only we as a country, but we as globally are able to overcome this unfortunate pandemic that hit us last year in since Jan 2020, and more so India in March and April 2020. If we are able to overcome this situation sooner rather than later, then I think economies across the globe will start contributing, and I'm quite sure India will lead from the front. And in that scenario, I think keeping in mind an improved uh, domestic data point, we should be maybe closer to 17,000 on the Nifty spot. I hope I'm right on that, and I'm keeping my fingers crossed.
Thank you, gentlemen. With that, we come to the end of our session. Um, just to wind up, is there anything that Dr. Vijayakumar wants to add to what Mr. Shah just said?
Nothing in particular. As an answer to the last question, how the markets are likely to behave in the coming months, well, let me end that on a very lighter note. Peter Lynch once, the legendary investor Peter Lynch once delivered a lecture in the US, and after the lecture, he was asked, "Mr. Lynch, you are one of the most erudite persons in the market now. So can you tell us how the market will behave today, I mean tomorrow, day after, in the coming weeks?" He said, "Yes, of course I can." Then he said, "Then please tell us how the market will behave." And he said, "Next week, the markets will be volatile." Right? So volatility is only what can be predicted accurately, nothing more than that. But in the long run, we will be doing good, no doubt about that.
Thank you, gentlemen. And with that, we come to the end of our session today. I just want to add that at Geojit, we're always striving to be there for our clients. You can always reach out to us through our branch, our customer care, or even our WhatsApp numbers. We do also, many of you asked if we have regular recommendations or portfolios that we share. We do share that to our clients through email. Apart from that, you can always find it in our Geojit Insight magazine, which comes out every month, where our research team gives you a model portfolio. This also suggests stocks for recommendation. There are mutual fund recommendations also over there. You will also find Geojit's mutual fund rating. So you can go through that and see which mutual fund suits you the most according to your risk appetite and your needs. So the link to all these will be provided in the chat box. Do have a look at all that. And we're always there for you. So thank you, and have a nice day.
Thank you all participants,
Thank you.
and I thank you for the